All right, we're ready to roll.
All right, we good to go? Good?
Yep.
All good. All right. Thank you, everybody, for joining up today. Like Logan said, on this Saturday, taking the time out of your weekend to come hang out with us, kind of learn some more, and hopefully we get some production out of this. Hopefully you guys leave here a little bit smarter than you came in. And yeah, today we will be talking about secondary indicators, part 2. We have done a bi-weekly call talking about indicators where we did dive in deep. But today it's going to be a little bit different, where we're going to be talking about the real basis and the real heart of secondary indicators, which is the moving average, okay? So in this lecture, we're going to be covering a few secondary indicators, but like I said, mostly the moving average. And, we're going to be talking about all stuff that has to do with moving averages. So we can get right into it, Logan.
Oops, sorry
Here
about
we
that.
go. So these are the 4 types of oh, you can go down. You can skip that. Sorry about that. Yes. These are the 4 types of moving averages that we're going to be discussing today, that we're going to be going really in depth. I'm sure you've heard of the simple moving average, which is the SMA, the exponential moving average, which is the EMA, and then the other 2, which a lot of people don't really talk about, is the weighted moving average, which is the WMA, and the smooth moving average, which is the SMMA. Okay, so those are what we will be discussing here starting off. And, first off, we'll be talking about the simple moving average, which I'm sure you guys are all familiar with. But the simple moving average is what it is, right? It's simple. It's the basic moving average that I'm sure you guys are all used to, right? Just like all the other moving averages that we talked about, the 4 that we mentioned, the SMA takes data from a set period of time and calculates the average price, which is then visualized as a line on the chart, right? Just like all the other moving averages, right? The simple moving averages is very... Right, exactly what it says, simple. It's very much the basis for the other types of moving averages. And go ahead, Logan. Yes, and for each one we will be diving into, the math that goes in behind this, right? Because, maybe we're not all mathematicians here, but it's good to visualize what goes into calculating these equations and how these lines are calculated on our charts. So it's pretty simple. The simple moving average is fairly easy. The other ones are a little bit more complex. Ooh, we got a little bit of an echo there. But we're good, yes. So that's the math right there. You can skip to the next one, Logan. I don't want to spend too much time on the math, but just to visualize it. So this is a chart of plug power, PLUG, on the stock market. And right here I have the 20-period SMA. I believe this is a 20-week SMA on the one-day chart. And it's actually quite amazing to see. And this is just as simple as it gets, right? It's just showing how a SMA on the broader term can actually identify support and resistance lines, right? It can really show the difference between a bullish market and a bearish market. And you can see here how earlier on in March we were bouncing on that 20-period SMA, the 20-week SMA, and then as soon as we broke below, we did fall into this bearish pattern where we stayed below the average the average price, the 20-week SMA, for quite some time. And as you can see by the green and red circles, right, where we had support and then we had resistance, right? We challenged that resistance for quite some time. The moving average actually worked stronger as resistance than, let's say, a trend line, right, or any other mode of resistance. This was, I would say, would be the most accurate form of resistance during this trade. And you can see as soon as plug broke above that resistance, we have really initiated a new market structure, a new pivot, and we are kind of getting back to things with some bullish momentum. So you can see how a break below a simple moving average or a break above a simple moving average on higher time frames, even on lower ones, can often decide the difference between a bullish market and a bearish market, right? And a moving average can help you visualize that, right? So this is just a very clean example of what that would look like. Logan, you can go to the next one here. And this is the same chart, only expanded. And you can see that we've been holding that 20-week for such a long time, and it's actually allowed us to have such a bullish market, right? If I were to tell you the percent gain, I could see plug was damn near $2, and we ran all the way up near $80, right? And that whole time we were maintaining above this significant moving average, right? There's obviously a bunch of different moving averages that you can use for a bunch of different time frames, but this is just a great visual to show how being above the average price, right, especially the 20-week, can be very bullish for price action. And then the moment we did break below, it was very hard for us to come up. And now notice we do have a orange circle or yellow circle down below. I would very much consider that what I would say a deviation, right, from the trend line, right? So we didn't really get that bearish market pressure from breaking down. We were able to come up right away from that really quickly and then form support on that moving average line, and that's what kind of uplifted us straight to the moon, right? So really good visuals here to just show how important a moving average can be. It's one simple line, one simple equation that we just showed, yet you could have made a ton of money just trading this one line. So it's pretty remarkable, and we're going to be going into it about showing how all these other secondary indicators, right? And we're going to talk about a bunch of them, how they implement moving averages as like their core basis for, deciphering price action, right? So moving averages are very, very important. Go ahead to the next picture. I believe there might be one more. Yes, okay, here we go. I thought there was one more for SMA, but apparently not. We are here at the exponential moving average, right? So these are the two popular ones that we just talked about, the SMA, and now we're on the EMA. The exponential moving average is another lagging indicator similar to the simple moving average. The main difference between the two is that the EMA places a greater weight and significance on the most recent data points, right? So it's very much similar to a simple moving average, only the EMA react to price action quicker than the SMA, right? So if we see a sudden jolt in price action to the downside, the EMA will react much quicker to the downside than that of an SMA or a simple moving average, okay? So I think that's a pretty simple explanation. I hope you guys all understand that. Again, this is the math behind the exponential moving average. Again, and I'm not crazy into math, and I don't do this stuff every day. I'm not constantly looking through these equations, but again, it's good to visualize. It's good to actually know what goes behind the lines that you're using in a possible trading strategy, right? So, take note, right? Maybe the math is important to you, but we just feel like it's important to visualize that, right? So go ahead, let me skip to the next one. And here we have some visuals. This is the S&P 500 ETF SPY that we all know and love, and this is displaying some very significant exponential moving averages, right? Here's the 50-week EMA and the 20-week EMA, and it's actually pretty impressive. This is another thing, right, that you could have just traded this and made a ton of money if you were to implement this into your strategy. The moment that we saw the 20-week EMA cross below the 50-week, which is the higher period time frame, that was the signal. That cross was the signal to a much further push to the downside. Obviously, we recoup and we get back above quickly, but it's very intriguing to see how just two sets of lines, right, the exponential moving average, right, and this could be done even with a simple moving average, can show, right, like we looked at as plug, can show the difference between a very bullish time and a very bearish time, right? And this is obviously can help with trades. And I believe we can go to the next slide here, Logan. Perfect, right? And we saw how we crossed, right? This is, by the way, this is a chart of Microsoft. We saw how go back to the slide real quick, Logan, just so I could point out the differences. Sorry about that. We see how we were examining across here, right? We weren't necessarily utilizing it as support. We were utilizing it to say, okay, are we bullish or bearish right now? Obviously, we could see that we bounced off of it as support. But if we go to the next slide, that's where we go into the next slide. Yes, we can see this is Microsoft on the 3-day chart. And we can see that those same moving averages, right, we never got across. We've been in this bullish state for quite a while. Obviously, we've had our deviations, our small breaks below the 50, but in reality, man, Microsoft has been on a very, very bullish trend, right? And we can say this with confidence because of what we see with these moving average, right, and of its average price. So it's very cool to see how these moving averages can serve as support, and they can tell you really quickly, right, is this bullish or bearish, and then if we go to the next slide, right over here, yes, and then this is the last slide explaining between the two. I kind of bring them all together, right? This is using the 20-period SMA and the 20-period EMA on the 1-hour chart. So these are 1-hour SMA and a 1-hour EMA, and we can see, remember we said that the EMA reacts to price action quicker than that of an SMA. So when we saw the cross of the EMA below the 20-period SMA, we could see right there our first circle. We could see the red line crossed below the blue line, hence starting a pretty bearish pattern, right? We continued our downtrend, right? And then the moment that we kind of confirmed our pivot of market structure is when the EMA crossed back over the SMA in a bullish way, right? Because the price action went up, so the EMA reacted quicker to the upside, and we got that moving average cross, right? So in many ways, the cross between these two moving averages on many different time periods can identify bullish and bearish market structure. Okay, and I'm sure Logan will go in much more depth about how that stuff works in just a moment, as soon as we talk about the other two moving averages.
Yeah.
But I'm not sure. Do we have another one? I believe we are. Yes. Now it's your turn, sir.
Absolutely. So I actually wanted to quickly go back and just bring something up. If you guys are in the moving average space, and you may have heard of the golden cross and the death cross, not exactly what we're looking at on this screen because we have a 20-period SMA and a 20-period EMA, but if you have heard those terms, all it is a cross just like this with a 20-period SMA and a 50-period SMA. In a bullish direction, that's the golden cross, and in a bearish direction, that is obviously the death cross.
Yes,
So
the concepts are right along there. Totally.
Yeah, I think you meant to say 200, but yeah, that's a huge thing. That's a very good entry point. I actually put out a tweet yesterday mentioning that on Bitcoin with Samara contracts that would have done 1800%. So it's the 50 crossing over the 200 is
right to 200.
basically just saying the past 50 days are performing better than the past 200, and then same with if it crosses below, it's saying the 50 days are performing worse than the past 200.
Exactly.
So
Yeah,
definitely
absolutely.
something to keep an eye out for.
So something also that we wanted to keep in mind that we actually we're going to bring up earlier is essentially all moving averages are dynamic support and resistance levels. So moving into our third and a little bit more obscure moving average is the smooth moving average. The smooth moving average is an exponential moving average only with a longer period applied, and you'll notice this very distinctly in our example in the next chart. The smooth moving average gives the recent prices an equal weighting to the historic ones. The calculation does not refer to a fixed period, but rather takes all available data series into account. So, moving into this next picture, you can see the math for the SMMA, which is the smooth moving average abbreviation. Like Austin said, the math doesn't really matter too much because we're lucky enough now to have TradingView that automatically calculates it for us, or whatever charting platform you use. Regardless, it is good to know in a framework what the equation is, just in case, maybe you don't have TradingView or your charting platform available. So going into our example of an SMMA on a chart, obviously you can see here that it does work for support and resistance, as we were just bringing up, but you can see, judging it from a normal 21 MA, this is much larger of a time frame. As you can see, the SMMA is moving away from price in a more gradual way than a normal moving average would. So now moving into the weighted moving average, and just something to also preface these two is, I don't know if anybody in here uses the smoothed or weighted moving average, but I know none of the analysts do use those two specifically. Just from our personal experience, and Austin, correct me if I'm wrong, and Cody as well, but in my experience, as well as talking to Jacob and Clayton, moving average and exponential moving averages are much more reliable than these other two.
Yeah, I think you hit it right on the button. I would say they are rather obscure. And we might get people that disagree, and they're like, weighted moving average is the only truth I know, right? Maybe there are some people like that, but Logan's 100% right. The SMA and the EMA are definitely the more reliable and consistent ones that we utilize here at OBR Investing. But go ahead, Logan, sorry.
No worries. So the weighted moving average, with the abbreviation WMA, is obviously a technical indicator that assigns a greater weighting to the most recent data points and less weighting to data points in the distant past. Unlike the EMA, which calculates the averages in an exponential system, the WMA tracks data at a flat rate. So again, here's the calculation. And here is the WMA applied on a chart. Here is the 21 period. So you can very, very easily see, look how close to 21 is, even in the weighted moving average, look how close it is to price. And then comparing it to the smooth moving average we just went over. So as you can see, the WMA and the EMA are going to look very, very similar, but obviously have their slight differences. And you can see here, we use it as resistance right here, and then support towards the right-hand side of our chart. And here is an example of the same period, 20 period, moving average and exponential moving average laid over each other. You can see, even with the same period, they're going to show you different prices. So it's very important to see which works best for your system and which works best for your trading style specifically. And here is another overlay on the 1 hour chart on Nano. As you can guess, we always use that chart, right? The moving average is in red, the 21 moving average, and then we have a 9 exponential moving average and a 200 exponential moving average as well.
Can I point out something with that one, Logan?
Absolutely.
So if you see in between the 25th and the 26th on there, when the 21 MA moves down to the 200, that would actually be a pretty good entry point if you were looking at it, because the 21-day moving average coming down to the 200, obviously the 200's like your super significant, important longer term moving average. So whenever you can have a shorter term, like lower time frame, your 21 or your 9 or whatever, move towards the 200, if it holds and you kind of see that bullish price action with those bottom wicks like starting to show up, that's definitely a good sign for a possible turnaround for sure.
And it makes sense because we propelled right to the upside right after that.
100%.
Yep.
I hope everybody can see that, because that is a great point. Seeing that price action where, seller's weakness is starting to show, bouncing off that 200 or EMA with that 21 MA, and then prices continue to rise. So now we get into why using moving averages, because we obviously just went over all the different kinds. So moving averages obviously provide a common average price for any given security that you place it on the chart. They are incredibly popular, so many people are trading based off of them. And as we know, markets are speculative, so the more people we have buying and selling in different areas, the more accurate those levels are going to be. They are useful for determining trends in price action, which we will get into very, very shortly, how to use moving averages to determine trend. They also provide widely used support and resistance levels and indicate bullish or bearish moves in relation to the average price. So why are moving averages important? And we're going to bring in a quote that me and Austin were laughing about yesterday. Moving averages in trading are actually a very essential part of secondary indicator trading, and that's why they're so commonly used. And I was telling Austin, moving averages are kind of like water. And when I say that, I mean it in the way that they are literally the backbone for almost every single secondary indicator available. And the only reason for that is the mathematical equation, which makes up a moving average, is required for many indicators. And you'll even notice a lot of indicators that you use now do look like moving averages.
Yeah, I like the moving average like water, man, right? It's the basis of a lot of the stuff that we use, that we implement into our trading strategies. So it's very important to understand what a moving average is in all the different types, So, and obviously, we have examples here of our other indicators.
Yeah, and you can use this information as a backbone for starting, whether it is, getting into your own system that you want to create or whatever it may be, just implementing moving averages in your existing system. But some examples of indicators that utilize moving averages are Bollinger Bands, which use moving averages in a deviated way. So there's a total of 3 moving averages in the Bollinger Band system, 2 of which are deviated, which is the top and the lower Bollinger Band, and then there's a middle 21 moving average. The MACD, the super trend, which is essentially just a moving average ribbon, the collection of multiple moving averages, and also one that all of our equities traders are very familiar with, VWAP. So now we're getting into defining trends with moving averages. So we're taking all this information that we just got and we're putting it into practice now. And for this example, we're going to use the EMAs because that's what I most commonly use, and I think what most of the analysts most commonly use as well. For trend identification, we're going to use the 5 different EMAs with different time periods. So those time periods are going to be the 8, the 21, the 34, the 50, and the 200. And when looking for trends on a chart, we defined a strong uptrend as a situation where the 8 EMA is above the 21 EMA, the 21 EMA is above the 34 EMA, the 34 EMA is above the 50 EMA, and the 50 EMA is above the 200. And as you could guess, when we're looking at a downtrend, it's the complete situation, vice versa. So here's an example of a downtrend. As you can see, the 8 is our yellow, then we have the red, then we have the red is our 21, then we have the 34, the 50, and the 200 as our blue. This is a downtrend. As you can see, all the EMAs are fanned out, moving in a very, very nice downtrend.
One thing I'd love to bring up here on this one, Logan, in particular, is you can see the black line, which is the 50, and as we were talking about that golden cross, it does, starting on the 24th, move towards the 200 day, and as you can see on the 27th, it doesn't actually break above the 200 day. It kind of creeps above it, it looks like, for a second,
right
but
here.
then we see right above that, if you look at those candle bars, we actually see a tweezer type projection. So if this is an hour chart, if you looked at a 2-hour chart, that'd actually be an inverse hammer. So definitely something pretty bearish, and yeah, as you can see, the 50 never crosses the 200, so it definitely a bearish chart here. You can definitely see that.
And now we'll look at it in an uptrend. Obviously, same colors, all fanned out in the uptrend, right? So as you can see here, we have this cross right here after the 24th, and after that, we start forming a very, very nice uptrend with all of our EMAs fanned out, 200 on the bottom, and moving up 50, 34, 21, 8. So that was our slideshow. Now we're going to move into the charts for a little bit, as well as answer any questions you guys may have.
Awesome. Yeah, that was really good. That was really good.
Them into the chat. But as of right now, I'm just going to spend the next minute and go over with you guys how to actually apply moving average to your chart, because we realized that there's a lot of new viewers in the last couple of weeks, a lot of new people. Very, very happy to have you here, and this is mainly used for you guys. So when you are on TradingView, which is our preferred analysis platform, you're going to find very, very easily the Indicators tab in the top of your screen. So you can easily just click on that, come down into this Indicators and Strategies. It will not say moving average here because I have it in my favorites, but very, very easily you can just go into the search bar and type in moving average or moving average exponential, moving average weighted, smooth moving average. They have plenty of moving averages from you to choose from, obviously, even a bunch of public ones. But we're just going to go with the regular moving average and an EMA.
Yeah, we recommend the built-in ones by TradingView.
Yeah.
Yep.
And then if you want to change the settings, you can just click on the little gear, or you can even double click on one of the EMAs on your chart. And there it'll show you the length, and that is the period that we keep on referring to. So that's pretty much going to be the data that it collects from. So when you have a 9-period moving average, it's taking the period of the last 9 candles, whatever time frame you're on. Unless you, of course, specify to only take it from the daily. As you can see on the time frame here, you can specify that you only want to take the daily moving average, for example. So here, you can change it to 21, and that'll change it. And then if you want to change the other one to 50, you could very easily do so here. And then if you would like to change the colors, so you have some aesthetics on your chart, you can easily do so by going to the Style option when looking at your moving average.
And then even then, Logan, right, if you can, just looking at the moving averages here, you could see that cross from the blue line down below, right? It initiated that bearish pattern. Then we rejected off of that moving average band a few times. And then as soon as we finally got above it, we took off. It was off to the races. And this is the S&P 500. This is SPY, you know?
Fantastic. So what kind of questions are we looking at right now? Using the EMA rule you just went over, can we look at Facebook and express your opinion? We absolutely can. Let's see if we have any questions right now, relevant to moving averages specifically rather than analysis, but we can absolutely do that later. Can you show us the indicators you use for moving average? Is there one indicator that has all of the moving averages in one indicator? That is a very, very good question, and I know on the public library you can find. Let's say you're using a TradingView subscription and you don't want to pay for Pro Plus. I know for a fact you can find moving averages, multiple of them. Like see right here, 4 exponential moving averages. There's multiple things on the public library which you can get multiple moving averages to get around that indicator limit you have on TradingView. But in regards to indicators that I use for moving averages, the only ones I use moving averages specifically on my charts, I do also use a ATR with an EMA overlay, an exponential moving average overlay, as well as a trader's dynamic index that also is utilizing moving averages and is a separate indicator. How about you, Austin and Cody?
Yeah, I'm a huge MACD guy, right? So moving average convergence divergence. It's a big momentum indicator that utilizes average price, and the cross of the MACD cross on many time frames to me can be more than enough for a trade confirmation in many cases. Obviously, there's other technicals that go along with it. The MACD is definitely one of my favorite.
Yeah, I use simple moving averages. It really depends on if I'm looking to go long on something or if I'm just kind of like scalping or looking to swing something. If I'm looking to go long on a stock, I'll definitely look at the 50 and the 200 and see where those are in relation to each other. And then for any normal swing, like what I normally alert, that'll be just the 9, 14, and 23. And I usually pay attention to the crosses, obviously, and then I just use them for support, really, support and resistance, and then line those up with my support and resistance levels I've found on the chart.
What do you use for as like a secondary indicator though? Like, do you utilize MACD or the ATR like Logan? Like, what else do you use? Do you use anything that incorporates moving averages? Gotcha.
MACD for sure. Yeah, I mean, your momentum average convergence divergence.
Moving average convergence divergence. Totally. Yep.
Cool. So Carrot King asks us to go through a few more examples of it crossing and explain the crosses one more time. So I'll do this once, and then I know Austin and Cody will probably have some stuff to share as well.
Yeah.
But here I'm using the 21 and the 50 EMA, And when you're looking at a cross, it's not necessarily there's two different ways to look at it, right? So you can look at it in the way of a candle crossing through the moving averages. So for example, here is one example of that. This candle body is through both moving averages. This is what some people consider to be a cross through the moving averages. And then the other type of cross is when, for example, right here, when the moving averages actually cross over each other. So it's a little bit harder to see because the moving averages are behind this candle, but right on this candle, they actually cross over each other and form this uptrend that we obviously sustain for a very long period of time. And let's see when they don't even cross over again until right here on this candle right here. So that's just two examples actually of how you can use moving average crosses. I personally, in my trading strategy, my mechanical trading strategy, utilize the cross that is a body through the moving averages. I refer to that as a shift candle in my strategy, but Austin and Cody, do you guys use them a different way?
So you're saying just the way, how do I go about using a moving average in my trading strategy?
How do you go about using a moving average cross?
Yeah, okay, perfect. Yeah, so you know me, Logan, and should I share my screen, or would that be too much? I don't know with your recording situation.
I would not be able to record it.
Okay, so that's fine. So I'm a huge fan of utilizing an SMA, an EMA on the same chart, right? So I love using the 20, for an example, right? And this kind of relates to Bitcoin, how I do my Bitcoin analysis, right? I pay attention to the 20-week SMA and the 20-week EMA or the 21-week EMA, right? And these crosses for me are huge, right? We don't always have to be, I know people talk about the 20 or the 50 and the 200 or so on and so forth, right? You don't have to necessarily follow what it tells you like the typical trader uses, right? You can come up with any combination of whatever moving averages you want. It's what's going to give you results and what's going to be consistent in showing you like the true is the market bullish or bearish, right? So I really like using a moving average band and paying attention to both the 20, like the same, like I enjoy to use the same SMA with the same EMA because that, right, the EMA is weighted more in recent price action. So even though they are accounting for the same amount of data, we can, you can identify a downtrend quicker, very, very quickly. And I could just send a picture of this into live chat so you don't have to stop what you're talking about, but you know what I'm talking about, Logan. I call it the bull market support band. So don't a few other people's, but yeah, moving averages are definitely huge in the way I go about trading. The crosses especially, right? And there's a picture right there that I sent to live chat VC Mute. I'm sorry for the people that are watching this on a recording. You may not be able to see it, but for the people in here, you can definitely go check that out. The visual that I'm looking at right now. So yeah.
Cody, anything from you?
Oh, he might not. We might have lost him. But oh, you got it. You got my visual up right there.
Sorry, there we go. My bad. I didn't realize I had my mic muted. But my typical strategy on like a day trade or like a weekly swing on a weekly contract would be the 9 and the 14, and using a 9 crossing under the 14 or a 9 crossing above the 14 to determine calls or puts, and then I typically use the 14 as like a resistance or support for exit or entry. That I found to work pretty much on most anything when it gets a decent bit of momentum in a certain direction.
Cool. So Sawyer, sorry, what were you gonna say?
No, I was just gonna say, and I think the conclusion we can come to this is, right, we understand how important moving averages is. We understand that it is like water. It is like the makeup. It is the general basis of secondary indicators. But they can be used in a variety of different ways, and it's largely subjective as to how you would like to make your trading strategy, right? That's why in the beginning of this this presentation, instead of showing strategy, we explained what they are. Right, because you want to understand what they are, and then from there you can go and just do so many things with it. Right, when I first started trading, I was playing around with so many, like just the most obscure numbers. Like I was sitting with Cody, you can attest to this. We were looking at a 400-week moving average, just kind of laughing at it, and it was actually, right, if you go look at the S&P 500 chart, SPY during the COVID capitulation of March 2020 found support on the 400-week simple moving average, right? So it's quite amazing, and you can get you can get very creative with how you go about utilizing them. Even on your secondary indicators like MACD or Super Trend or VWAP, right? There's so, right? It's really endless possibilities with how you want to go and utilize moving averages. So
absolutely. So Sawyer asks, where do you get your N inputs from? Like 9, 21, 50, 200, or Cody just said 9 and 13. Yeah, so that's also a very, very good question. When you're saying the inputs, you're referring to the period. Yeah, so that is mainly going to be preference and what works best for your strategy through your own testing. For me, I noticed, and also, by the way, a lot of these are periods that a lot of people are using. You want to use periods that a lot of people are using because we want the most people on our side when we're taking a trade. That being said, the 9, the 21, the 50, and the 200 are some of the most popular moving average periods that you can come across, as well as the 100.
Those are definitely the most significant.
Yeah. So that's why I personally use those. Cody, is there a specific reason you like to use the 13?
So yeah, I mean, with my shorter term trades and like my weekly trades, I'm usually gonna stick to something under 50 and even lower, under 30, more than likely. But that being said, you can definitely use 50 and 200s on a weekly basis. I mean, if you saw 50 cross the 200, you could still enter weekly contracts and probably make a killing. But yeah, I usually stick to a time frame that's more acclimated to where I'm like positioning myself to trade. So if I'm looking for weekly contracts, I'm gonna use a lower time frame. Versus if I'm looking for a leap or even just a longer term swing, I'll use something more like the 50 and the 200.
That makes sense, aligning it with your time frame.
Yep. And folks, these moving averages, right, as we said, they can be used on any time frame for really any trading strategy, right? If you're a scalper, then you're just on a smaller time frame, but you're still utilizing the 20, the 50, right? Even if it's for a 1 minute, right? These moving averages can be used at any time frame for any kind of trader. Even a long-term trader, like I would consider, I'm very much a long-term investor. I love to look at the macro view, right? So I'm always like looking at the weekly charts, like trying to get the whole picture, right? And I love to use moving averages like that. And then when I'm day trading in the equities market, I'll go down and I'll use smaller time frames. So it's really just, you can use, like I said, the possibilities are endless with these things, So yeah, is that it? I mean, if anybody has stuff like a discussion, is there any correlation between moving averages and RSI? No. Well, RSI is relative strength, so I suppose it is. I don't really know the math behind an RSI. I can't confidently tell it. Logan, do you know how an RSI is calculated?
I know that.
It's okay if you don't.
No, I don't know the specifics, but I know that it is a type of moving average.
Yeah.
Can you show us an example with MACD in the EMA? Austin, I think that you would be better suited to show that.
Yeah. So pretty much there's not that's don't think about it like that. Pretty much what a MACD is, right? The stuff that make up the moving average convergence divergence is the stuff that's used to make up, right, the moving average. It takes average price data in order to form the indicator, right? It uses moving averages in order to form the indicator and to kind of to allow it to work, right? Because that's how it gets the data. It utilizes average price. It's a lagging indicator along with moving averages, right? It's not necessarily, you don't necessarily use an EMA along with the MACD. It's just kind of its own indicator that very much is off the basis of moving, the idea and concept of moving average and average price and momentum, right? So
yeah, here's a picture of the MACD actually right here. You can see that it is really just two moving averages.
Yep.
And you can see how it's
on that the same way. It's
exactly. Yep. So it's not like you're applying it. You can. TradingView will give you the option if you wanted, and Logan, you know how to do this, right, to make hybrid stuff. If you wanted to throw something over your MACD and maybe you found use of it, you could certainly do that, and Logan's doing it right in front of our eyes right now. Look at that. Is it a yellow line, or what do we have?
Yeah, it's the orange line right at the bottom.
Gotcha. Make it red or black or perfect. Look at that. So yeah, you can do anything. That's an example. Now, would this help you? I would probably say no, right? The one that Logan has, but there's a lot of creativity and there's a lot of stuff you can definitely do with in regards to TradingView. But yeah, you can certainly overlay whatever you want on any indicators. And look at, he's doing it right there. That's great. So that could be useful. I would argue that that's useful, right? It gives you a third data point on top of your MACD already. That it looks like a little ribbon. Not too bad. Not too bad. I kind of like that actually. That's interesting. So I hope that helped, Carrot.
See, we have another question typing.
You guys are the best. Hey, we try, man. We
You
try.
are the best, Carrot King.
We want you to learn about moving averages. Hopefully you can leave this talk and you'll be able to you'll know a little bit more about your moving averages and you know, here at TA God has learned. Great, love it.
I think
sorry.
I think something fun for you guys to do would just, I mean, go apply some moving averages to charts that you traded this week and look at where you could have applied a strategy to it. I mean, if you find something that worked, and you can look back on that chart and find other situations where it worked, and if you see a high probability chance where anytime that certain situation arises, it always works out that certain way, you could definitely create a strategy through that. And definitely use it next week. I would recommend any start of a strategy to always start it with paper trading.
Yep.
But that being said, you could be on the verge of finding something pretty special.
Logan, I have a question for you. Would you recommend that every trader should utilize moving averages? And I know that may sound like a stupid question, but it's a serious one. How do you feel about that?
I think everybody should use moving averages in some way, whether that be actual moving averages on the chart or a MACD. There's no reason not to, right? Because these things are a great confluence for trading decisions. So whether or not they actually cause you to enter or exit a trade, they can always be confluence. And for people that don't know what that means, it's just things that align with your viewpoint or obviously go against your viewpoint as to why you should not take the trade. So either way, I think people should be utilizing moving averages of some kind, whether that's Bollinger Bands, MACD, whatever it may be, or moving averages on your chart. How about you, Austin?
Some sort of exposure in general to average price. Yeah, I agree. I think the more data, the better, right? If your chart doesn't have moving averages, what's it going to hurt to throw it over, right? It could visualize stuff for you that you were not able to see before, you know? So, here's a good question. This one could be around you, Logan, and I guess this kind of ties into moving averages a little bit off to the side, but he just wants to talk about stop losses. Do you really need them? And
yeah, I actually just commented on that guy's question.
Oh, you did. Sorry, I didn't see it.
But I wanted to go back.
I'm sorry. We can skip over that. My apologies.
So S. Barba asked, using the EMA rule you went over, can you look at Facebook and express your opinion? Yes. So looking at Facebook, as you can see on my chart actually right here, what I just did was we're using the 50 and the 21. As you can see, we were in a downtrend after we actually had this EMA crossover right here. And as you can see, moving averages are getting closer together, prices moving higher. There's a high probability that we have a bullish moving average cross, and maybe this is our reversal of trend and makes Facebook continue higher in the near future.
Facebook looks textbook. What you have right there, that's just textbook. You can see when we had that crossed in the bearish downtrend, we really went down, man. And then we actually even attempted. We thought we were going to cross before, but we got rejected and got pushed down even lower for a second time. But hopefully now we can get that confirmed cross. What are we on right now? The 4 hour, right? So that would be fantastic.
Thank you.
Yeah, of course. Anything else regarding moving averages or indicators that are related?
Sorry, I'll type it in the chat.
No, I mean...
You can use your mic.
Yeah.
Okay, it was about the Bollinger. I was using that when I first started, and then that pushed me away, and then I only use MACD on RSI, but could you do a little bit of an explanation again on Bollinger, on when you would use that, if it's for short-term or long-term?
Yeah, so that's actually something that we could have a whole conversation about. Bollinger Bands. Bollinger Bands are really used very, very well for mean reversion trades. I'm not exactly sure how you were using them, but essentially what it is it's two deviated moving averages from the basis, which is the 21 moving average. And the way that I was always using Bollinger Bands was looking for extremes of price when they reached the higher or lower Bollinger Band, finding a candlestick pattern or a price pattern, and then trading it back down to that 21 or up to the 21, back to the mean. Does that answer your question?
That was exactly what I needed to hear, because I was using it for that reason, and when I saw it break through, it continued to pattern outside of the band. But I was just trying to figure out if you use that in more of a short term or a long term.
Yeah.
As confidence.
Yeah, I think you can use it in either, just depending on your time frame.
Okay, thank you.
Yeah, absolutely. So somebody said, can you take a look at Tesla? Had a death cross and then a golden cross right after that, like a daily back in August.
Yeah, I was actually looking at that right now. I would consider that in some ways a fake out. Yeah. The only
Definitely
reason
a
I
fake
would
out.
never, or I wouldn't enter a put position on that death cross we saw, is you actually never see the candles break below that 50. So that 50-day SMA, at least on my chart I'm seeing, we
Yeah,
do see
yeah.
a little test below, but it never holds, and they reject, and we see it hold that 50-day. So. That is an example of a fake out, but I personally wouldn't enter a put position until you see the candles close below the SMA.
Yeah. I hope you guys can see that on my chart, actually. I pulled that up as well.
Yeah, that's beautiful. Yeah, and that just goes to show, right? You can't 100% rely on these things. It's just more confluence, more data for you to use in your toolbox, for your decision making.
The trader tool belt.
Yep.
Cool. Any other questions?
Yeah, I have a question.
Awesome.
What's up, man?
Well, what do you think about the DMI indicator? Is it good for day trading or long term?
Could you say the name of the indicator that you were saying again?
DMI.
DMI.
Yeah.
Directional movement index. So I've never had any experience with this. I've heard of it. It does seem I'm looking at it right now on my screen. I've never really used this in any of my trading strategies, so I don't feel confident enough to speak on its behalf. But it does look like it considers average price, for sure. I don't know, Logan, have you had any experience with this indicator?
No, I have no experience with this, but I have heard of it before. It does look very confusing. I'm not really sure how you'd be able to use this information.
I use it when the green and the red crossover.
Okay.
And it's great, yeah.
Well, if it works for your strategy, then I would continue using it.
Okay, thanks.
Yeah, absolutely.
And it's good, right? Like I've never, right, me and you, Logan, I don't think we've ever even had a conversation about DMI, but now I'm sure we will, right? So it's like you guys even saying this stuff is good, right? To bring up, like, what do you think about that? Because there's some times where we don't even know ourselves,
There's so many indicators.
Oh my God, it's disturbing the amount of indicators. And right, and we say that moving averages are the basis of a lot of this stuff, right? So it's like you can imagine the world. It's like so vast, right? It's very difficult to know everything. Yeah, so many indicators. A lot of oscillators. Yep. When using moving averages in the short term, do you take into account after hours? That's an interesting question. And that would really only apply to equities traders, right? So Logan doesn't really, right? The forex market's 24/7. Like
Yeah, I wouldn't have an answer to that question.
Right. So do you take into account after hours? You can. I personally keep my charts just on regular hours, right? When I'm equities trading. But if you want to view it, just it's good to flip back and forth, right? And to see maybe if you find something interesting, you could. But I typically ignore after hours trading. I will acknowledge it sometimes, but it's not part of my strategy to acknowledge that stuff.
Yeah, the only time I would use it is if you saw like a stock's share price like popping with no really relation to an earnings or anything. Because if you're playing an earnings, it's not going to matter about the moving averages anyways. But yeah, I mean, I guess you could use it in the after hours, but it's definitely not its potential, not its main use.
Okay, perfect. So that's that would be considered a deviation from the price if it was like an earnings report outside of your moving average.
For sure. Yeah, any
Okay.
sort of news coming in will deviate any indicator for the most part.
Thank you.
Cool. So we got a question about Ichimoku Cloud. What's the difference between Forex and the normal stock market? We'll just quickly answer this one because this is still revolving around moving averages, but Forex is the foreign exchange market and the stock market is stocks in the US or whatever market you're trading.
You're buying equities in companies, and then foreign exchange, you're trading different currency pairs around the world.
Right.
And I don't want to leave Saren, right? The Ichimoku clouds, yes, we are talking about indicators. And I have done a little bit of research on these. I've utilized them before. They do utilize moving averages. The Ichimoku Cloud, I don't use it, but it's kind of like that tool in trading. It's like it tries to be an all-in-one tool, kind of like a Swiss Army knife, if you will. It tries to tell you a bunch of stuff, right, ranging from support, resistance, momentum, all that jazz in one indicator, pretty much. And you know, it's okay. I've never really utilized it, but I've definitely heard people talk about it. So.
Yeah, I have a little bit of experience trading with the Ichimoku Cloud.
Really?
Yeah, back in the day. The two main things I'd really recommend is the Heikinashi, which is the baseline. That's the real name for it, the Heikinashi. I used that specifically, and I used the plots, which is this dynamic support and resistance, which is plotted for the Ichimoku Cloud. In terms of other indicators, I don't know necessarily because I don't know your strategy, but I like moving averages overlaid with the Heikinashi works very well. You could use Bollinger Bands with the clouds. There's a lot of different things you could do. Mm-hmm. Sparrow said, what time frame is preferred for candle bars for day trade and swing trading? For swing trading and day trading, I'm going to say 4 hour and daily.
Yeah, day trading, I might go a little bit lower. Swinging 4 hour and daily for sure.
I personally think every time frame is always useful. I mean, you can see
that's great. I love that, Cody. Yeah, I agree.
You can see a different story with every time frame. So I mean, it's like you just said, Austin. I mean, the smaller time frames for like day trading and like I would use smaller time frames to really look at like price action and kind of determine entries and exits. Maybe when it's like nearing a moving average or a support or resistance. Well, I would use the longer time frames like the 1 year, 1 day, while maybe seeing like a bull flag or something. But yeah, I mean every time frame can come in handy if you just look at it, and it'll all tell a different story while all kind of bringing the story together too. So
great. Any last minute questions?
I had all my questions answered about moving averages. I know that.
Me too.
How are you guys so good? Oh, you're making me blush. Yeah, but we appreciate you guys coming out on a Saturday to come out and hang out with us and learn about some moving averages and some technical analysis. It really means a lot to us.
Yeah, really absolutely. Thank you guys so much for coming out on a Saturday. This is bi-weekly, S-Barba. We do these every single 2 weeks, so our next call will be on November 20th. And we will definitely be seeing you guys there. We'll discuss our topic in the upcoming week. I hope everybody has a fantastic and productive
One more thing before
weekend.
we end this. Was this time okay? Like, how do we feel about this time? Because we have been experimenting with the bi-weekly time slots, and, you know, I don't know. We'll experiment with the time, but we definitely want your feedback, right? Was this helpful for you as far as time-wise? Was it inconvenient? Whatever. We want to make sure the times are good so everybody can attend, right? We want to make it so as many people can come in here and learn as possible, you know? So
it seems like the people in here liked it.
After this would be huge. Yes, sorry. Alrighty, Logan. I think we can wrap it up.
Awesome. Austin and Cody, thank you guys for coming out today as well. And everybody have a fantastic and productive rest of your weekend.
Yep. Hell yeah. Awesome. All right. Thanks, guys. Take it easy. Peace.
Thank you.
Bye.